Excellent. Well, thank you to the Shares Publication for inviting us once again to speak at this event, and to those who are shareholders, thank you for your support. I do see some familiar faces in the audience from when we were last year. So hopefully we switched up the presentation a little bit to update you on where we were last time, so hopefully you won't find it too repetitive. But for those who are new to the story, you could boil down Ecora really simplistically as a business which aims to provide global investors with de-risked exposure to commodities that fit within renewable energy production or low carbon energy production that are required to transmit that electricity and that are also required to consume electricity or to store it. And we do that via buying royalties over mineral deposits. So your next question may be, well, what is a royalty? And here we are. A royalty, simplistically, is in exchange for a payment today. We receive the right to a portion of the value of minerals when they're extracted and sold. And what are the key benefits of the model? Well, it's very different to being a mining company because Ecora is a financial investor. And our profitability and cash flows are a function of the production levels from the areas over which we have mineral royalties and the commodity at the prevailing time when those are extracted and sold. And that directly, subject to tax and other things, but that leads to our cash flow line. Whereas a mining company is different, of course. A mining company will derive its revenue by extracting minerals and selling them, but its underlying cash flows will subsequently be a function of subtracting operating costs as well as capital costs of constructing the operation and required to keep the operation within production. So generally speaking, what the royalty model delivers is a lower volatility source of cash flow. And secondly, is a business model that really benefits from inflationary pressures over time. And to give you an example, if someone were to buy a royalty over copper 20 years ago, at the time copper was approximately $1 per pound. So if you had a 1% royalty, you'd be receiving 1 cent per pound. And if you fast forward today, the copper price today is approximately $4 per pound. So today you'd be receiving 4 cents per pound. Now, if you're a miner, you would have seen your operating costs offsetting that increase in revenue by virtue of the inflationary costs of labor and other sources of operating costs and capital costs. The royalty model that flows directly through to the bottom cash flow line. So it's a great business model over the long term to get that de-risked exposure to the commodity basket in a diversified way. And this is Ecora today. We have deployed our capital in such a way that the bulk of our geographic exposure is to OECD jurisdictions. Our commodity exposure today by asset value is primarily weighed to base metals, with the core of that being copper. We've always thought to invest very defensively, and by that I mean, as a royalty investor, your assets are more likely to stay in production if they're operating with wide profit margins and can withstand the typical volatility that exists in this sector. And number two, they're more likely to come into production if they're over projects that are not yet in production, if they're expected to generate very strong cash flows relative to other projects of the same commodity. So we've built that portfolio to be very heavily weighed to defensive assets within the commodity complex. And then, of course, the stage of development today, 50% of our asset base is over producing royalties, the other 50% over assets that are not yet in production. And so those assets, of course, are not yet contributing to our royalty income and free cash flows. And we've done it by really targeting operations that are high-quality geologies, and high-quality deposits typically attract the best quality mine partners. Our partners include Vale, Capstone, BHP, Cameco, really household names, blue-chip names in the sector. This is a quick overview of our assets and our producing portfolio. And these are the key assets in our development portfolio. And by that, I mean assets that are not yet in production, but are progressing towards first production in time. And this gives you a feel for how we've positioned the business. So, if you went back in time to 2015, when we were all still part of Europe at the time, you would have seen that this business was materially concentrated really in one commodity. And that one commodity was met coal. And what you'd also see is that business was highly concentrated in one asset. And that being, again, Kestrel, or Kestrel royalty. And in 2015, we knew that that royalty would approach the end of its life by the end of this decade. So therefore, our challenge effectively was to deploy capital in such a way that when the Kestrel royalty ran off, we had a portfolio of producing assets of roughly the equivalent amount, and beyond that, add growth. And you can see when you look at our net asset evolution that a lot of capital has been invested into assets that are not yet in production, but the business, from a net asset perspective, has seen substantial net asset value growth. And from a bit portfolio that 10 years ago went from producing effectively zero, absent Kestrel, today we have a portfolio that has a path to doing $100 million ex met coal, so primarily in base metals and primarily there in copper. There's certainly an element of uncertainty as to when the development assets will come into production, and therefore our strategy from here on out really is to further deploy capital and diversify our sources of revenue over the period of 2025 to 2030, such that when one looks at the orange bar here, if you see it, those are assets that are not yet in production. It would just be more diversified against more assets, such that if one asset does well, that can offset an asset that does badly, and so forth. Or if one asset is delayed, another might come forward. Ultimately, with the aim of just positioning this business as a very low volatility way of getting exposure to both the commodity basket, but beyond that, the energy transition thematic. And it all really starts in terms of our ramp up in our portfolio with Voisey's Bay. Voisey's Bay is an asset that we acquired in 2021. It's an asset that has been delayed, unfortunately, not through the fault of Vale, but through in part because of COVID and the subsequent supply chain bottlenecks that it had on the entire world. That being said, we finally are at a point really where we see a major inflection point for this asset. If you extrapolate deliveries last year versus what we expect to be delivered in this asset by the end of 26, it's almost a 400% fold increase. If we compare the performance of this asset, taking cobalt prices in H1 versus fully ramped up, you'd see, again, just under 2 million shooting up to potentially just under 20. And that's with cobalt prices, and you can see this at the bottom right of the page, being cyclically very weak. So this is an asset that can do so much more for us. And we're really excited to finally be able to showcase the potential of this asset in terms of stabilizing our revenue line as Kestrel runs off, but also providing substantial price upside. As we all know in natural resources investment, ultimately entry point, in other words, buying your exposure at times of commodity price weakness like where we are today, is really 50% of the battle, if not more, to outperforming in this sector. This gives you a feel for what's priced in today. Like many UK equities, Ecora has not been spared some of the pressures that have affected many and all of us across the small cap space. In any event, from where we sit today, the equity offers a great dividend yield, spot prices of around 5%, and the interim substantial potential for capital appreciation. The opportunity exists to buy exposure to the portfolio at these levels for less than the value of our producing asset base, and effectively have the balance of the portfolio as free optionality, which is quite compelling, I personally think. So what's next? I touched on this briefly earlier. What we're really looking to do is infill, right? We've made big investments in big cornerstone assets, and these have the potential to run for multiple decades. And therefore, how can we improve the business? We think that we have 8 material producing royalties. We think that having 15 is better than 8. And we also think that having 20 is better than 15. And that similar logic applies to the development pipeline. We have a handful of excellent quality projects moving towards first production. But that being said, as the more we can diversify this portfolio by retaining a focus on high quality assets, in time what we hope to achieve is a virtuous treadmill, where effectively as we move forward in time, we have a natural evolution of assets within our portfolio moving from up the development curve and into production, and those coming into production replacing those that are ultimately being depleted. From a commodity perspective, we think it's a lot more of the same. Our focus remains base metals, and of that copper. We think it's a very interesting time to get lithium exposure. And in my opinion, I think what we're likely to see, especially in some of the commodities that are growing very quickly on the demand side, but are yet remain small markets, I think personally we're likely to see short periods between cycles and greater amplitude of the commodity price cycles. So if anyone's been tracking nickel or lithium, what you can see, and cobalt to a degree, is very strong underlying demand growth trends, but also very choppy supply additions. To build a mine is a bit blunt of an instrument. The supply comes online, it's not really possible to match 1 ton of incremental demand to 1 ton of incremental supply. And thus we've seen it with lithium already the past 5 or 6 years, 2 commodity price cycles, which is a very short period of time for 2 cycles. I think it comes back to the importance of entry points in that context. The lithium price ranged from $80,000 per ton to $10,000 per ton on the carbonate side, roughly. So as a royalty investor, the key for us, we think, is just to be patient and to pick our commodity price cycles attractively and to position our investments that we're benefiting from the upside in the commodity price cycle as opposed to needing it to meet our base case investment returns. So some detail here as to what comes next. And I won't go through this item by item, but I think the key takeaway here is as we go forward the next 5 years, what I think is really interesting about Ecora is that up to now the focus has always really been the Kestrel ramp down, and that's normal, I think, when you have one asset that's so important to a business. As that asset winds down, it creates uncertainty as to what the future will hold, and it just change and it just transition, and these things are always tough to do as public companies. But increasingly, I believe we're at an inflection point where the narrative will change from the Kestrel wind down to the ramp up of everything else we have in our portfolio. And all these assets, of course, are assets that have the potential to materially contribute, some of them already in production at various phases of development, but to materially contribute to our profitability over the next 5 years. And that's, I think, the next narrative that investors will be really interested, particularly given the copper exposure we have. So to summarize, when we look at the business today, we're expecting to see volume growth from the assets underlying our royalty portfolio in 24 from 23, the same thing into 25. We have a very strong balance sheet. We have 1.4 times leverage. That's well below our financial covenants, so we have room to make more acquisitions should they be compelling. Absent that, we're very happy to be patient and to deleverage and save our firepower for the next deal. We're really not in the business of getting points on the board for the sake of it. There are royalty companies that measure success in terms of the number of royalties they acquire. We think differently. We think it's really just about doing the right ones, and if there's longer gaps between deals, so be it. That's okay, I think. And thankfully our investors agree with that strategy for the most part. The portfolio is very heavily weighed towards copper, and I think when you look at copper and of any commodity, this is the one that we feel is the most interesting simply because it's one of the most constrained, but ultimately feeds into almost every aspect of that renewable energy transition. You cannot have renewable energy or a power plant without copper to transmit it. And the wind turbines, solar, all much more copper intensive than, for example, a coal plant, which this capacity is replacing. And similarly, you can't distribute the power for the most part without copper. There is a risk of substitution from aluminium, but ultimately that's, a lot of that has already come. The Ecora share price, as I mentioned, is very attractive based on where we historically traded. It's kind of unusual for this business to be trading for less than the value of its producing portfolio, but in the context of the uncertainty of the Kestrel runoff, does create that opportunity should one wish to capitalize upon it. The operators are really first in class, and our business pipeline is really a function of what is the state of capital market conditions. And it's very difficult in today's world, not necessarily for BHP or Glencore or Rio, but as you go down the tier of mining companies in the sector, capital market conditions are increasingly challenging. And at the very early end, there's almost no capital available if you were to look at the exploration sector. And for us, while we don't certainly look to the balance of our capital deployment strategy is not to early stage opportunities, it just creates an environment where we've seen in 2024 in particular a big, strong uptick in opportunities. and hopefully some will translate to royalty acquisitions. But if not, we're very happy just to pay down debt in the meantime and wait patiently. So that's Ecora in 14 minutes.
Thank you very much. Okay, do we have questions for Marc, please? Question over here, please, Chris, if you can reach that far.
Hello, Marc. I'm a long-term shareholder in what was formerly Anglo-Pacific. And like many investors, I always get a little bit nervous when companies change their name and mention ESG. Straight question I want to ask you is, if there was a similar hydrocarbon opportunity, for example, high-grade coking coke, like Kestrel, that produces most of the cash today, would you take it, or would you say, well, we're an ESG-focused company, we'll ignore the shareholder return on it?
Yeah, it's an interesting question. And what's interesting about it is that the Kestrel royalty was bought sometime in the 1980s when it was a sheep farm. And so for something like $200,000. It took 20 years for the asset to come into development, and it was a bit of a lucky piece. So to really answer that question, what you'd have to assume is today we'd be buying property for next to nothing for the hopes of having that asset materialize in 20 years from now. So to replace Kestrel, it's just such an amazing asset. It was such a lucky entry point historically. I don't think that's probably the right comparison that you're asking about. What I suspect you're asking, would we invest in met coal today, all else being equal, if it's a producing met coal mine versus copper? And then I think the reason that we've focused on another commodity subset is a simple one. And it's a question of horizon. In other words, most of the steel companies in the world today are doing almost everything they can to reduce their coking coal usage. If you look at the US steel sector, for example, there's been a massive pivot towards pellet usage, electric arc furnaces. So the blast furnace of old is an increasingly old technology. So then the question is, in this calculus, does one believe that the underlying demand trends for the next 20 or 30 years are more compelling for something like copper? I would argue yes. I think that the demand trends for met coal are interesting in the short term, but in the context of building a royalty company, the met coal, purely in terms of supply-demand dynamics, is unlikely to offer as compelling a demand growth story as some of the other commodities we focused on. So I don't think that the decision to move away from Kestrel is not a decision that we've made ourselves, right? And I think this is an important one. I think that's a really misunderstood point about Ecora. The Kestrel royalty is finite. We are not exiting Kestrel. We're not leaving that royalty. No, that royalty is just being depleted. So then the question is, what do you do next? And what's the best way to build a business that's resilient, right? That has exposure to commodities, that can deliver substantial capital appreciation as a result of the demand trends. And that's informed our thought process. So if that doesn't answer your question, I'll be here later. You can catch me then. But hopefully that gives you a feel for how we think about it.
Thank you. Questions for Marc? Gentleman here, please, Steve.
Thanks. Two questions. You say that you want to find the ideal time to buy a commodity. How do you gauge it? Because as investors, we're told you can't time the market. And secondly, who are your competitors, and what's your USP compared to them? Thank you.
Yeah, and the first, I think if timing the market, picking the top, picking the bottom, I think is a very heroic thing. But actually, as an equity investor, I think you have the privilege of being able to exit if you feel like, if an equity investor buys a lithium stock and lithium is on its way to 50 to 80,000, the equity investor can still sell the equity at 80,000 if they believe that's toppy. If we price a royalty at 50 to 60,000, then we have 20 years of that price deck, and if that price deck isn't the average over the next 20 years, then we're underwater. So we're not necessarily looking for the bottom. I think what we look for is commodities that are trading at levels which are low relative to their historical trading ranges. We look for commodities that are out of favor. And we look for commodities that, ultimately, just by virtue of where they're trading in their natural cycle, appear to offer asymmetric price upside relative to downside. But to say we pick the absolute bottom, I think that would be certainly a step further than I would have wished to represent. In terms of our competitors, it's a very small list, because the vast majority of folks in this sector are precious metals focused. There's a handful. I see we're out of time, but if you'd like to...
No, we've got some more time. Yes, we've got more questions, right?
Yeah.
Mark?
So in terms of the competitor set, it's a very small group. The transactions that we do actually are usually negotiated between us and the mining company, right? And what we've found in this sector is that if you sort of wait for the opportunity, it's almost too late. So we, for many years now, have been building relationships with management teams who are developing our own projects that we like. We think that would be additive to our project. And then we sort of wait for the right time. And we cover a big basket of commodities, so that's a huge amount of work. But that's in many ways our USP, actually. It's our experience in the sector. We've been structuring royalties between us and the team. We have something like 60 to 70 years of experience, and collectively, if not more, in terms of the cumulative years of employee experience. And we've been sort of visible. So if anybody who is looking to sell a royalty in this basket, oftentimes Ecora is the first port of call.
I had a couple of quick questions for you, Mark, if that's all right.
That's why you added the time.
The first is, what happens in a scenario where one of your mining companies, an operator, is acquired? Do you get cashed out of your royalty, bought out? Or is the royalty over the asset and the new owner of that asset has to carry on the same arrangement?
Yeah, I think the answer is depends. In the sector, you see instruments that have mandatory repayment clauses in the event of a change of control. And that's sometimes not a good thing for a royalty company, and sometimes it's a good thing for the royalty company. Generally speaking, our strategy here to manage counterparty risk is to go after good quality assets. And actually, in some instances, really good quality counterparties in the context of a change of control don't necessarily protect you. So we have one asset. When we bought the royalty, it was owned by a copper-focused developer and producer. BHP bought that company. And BHP, as many of you may have seen, have had issues in their nickel business. And as part of their wider nickel business, they decided to slow down the development of a mine over which we have a royalty. So on one hand, having BHP as a counterparty is fantastic. But on the other hand, it speaks to the need to, and our vision, what we believe is a critical need to further diversify this business and our income sources so that doesn't happen. In fact, I can't think of many instances, maybe on like less than one hand, where a counterparty has bought an asset of this quality and decided to mothball it, because the asset, West Musgrave, that mine in particular, is amongst the lowest copper and nickel projects in the world. And actually that asset, based on its cost profile, theoretically has the ability, and BHP has said so themselves, generate strong cash flows, even in a really weak nickel market. So that's probably the only instance I can think of where that has been an issue for Ecora historically. But generally speaking, our royalties exist, they apply, we have certain protections to ensure that the counterparties are not in breach of basic regulatory requirements from ABC type issues, these types of things, minimal experience and counterparties. But the best defense ultimately is just to get royalties over good assets, because the best assets typically attract the best operators.
The other question I had furthers the gentleman's question about trying to time the market or not timing the market. Would you be more comfortable with multiple investments in the same underlying asset, so 5, 6, 10 copper projects, so they get a blended royalty rate, rather than, say, fewer investments but maybe at a better price? What appears to be a better price that day?
Yeah, it's a hard question, right? Because then it depends on the scale of the price. But all else being equal, if you had to pick all else being equal between the same returns profile, of course one would pick more diversification, right? You'd want jurisdictional diversification, commodity diversification, counterparty diversification. Really, the royalty model really shines, and you see it in the precious space, when the portfolio is highly diversified, and thus it achieves very low volatility, right? And the key to that actually we're not looking to build scale for the sake of it. Scale is a natural extension, we think, of just being diversified.
Any other questions for Marc, please? Gentleman at the front here, please. Hey, Chris.
Hi, I believe your share price has been on a downward trend since April 2022. A lot of that is probably to do with the copper prices. But what do you think would mark an inflection point when the share price will start to recover?
Yeah, there's a few things going on there. I think the first is just the move away. One of the key assets in our portfolio, the Kestrel royalty, as I mentioned, the met coal royalty the gentleman referred to, is approaching the end of its life in 2030. And between 2023 and 2026, we're in this transition period. That's certainly one factor as the Kestrel royalty winds down and other things wind up in parallel. I think one of them has been a delay in ramp up at Voisey's Bay. That asset was expected to be running closer to full production today. And the context of the Kestrel and expectation of Kestrel running down, not seeing those units come through yet has created a level of nervousness. And then beyond that, I think it's unfortunate reality. Any small cap company in the UK has come under pressure in terms of equity outflows. We've seen a level of forced selling amongst certain of our institutional shareholders. And amongst that, we've also seen a trade away from Ecora as an income stock to more of a growth stock, right? Especially in some of the volatility that exists with Kestrel. Ecora and its portfolio being much more weighted towards assets that are not yet in production has resulted in a bit of a pivot and rotation in our register. So there's a number of factors. As for the inflection point, I think we've already begun to see it. And I think that all starts with the Voisey's Bay mine really starting to show to the market that it can do more. And H1 of this year, that asset delivered to us 4 sort of cobalt deliveries. 2 months into H2, we have one delivered, one's at port, and 3 are on their way. So in other words, 2 months into H2, we're tracking already better than we did in the entirety of H1. As that comes through on a quarterly basis, and as we continue to de-risk, or these assets are perceived to be de-risked in time, I think that's really key to seeing the share price move upward.
Super. Thank you, Marc. Any final question for Marc? No? Okay, well, we'll catch you over a glass of wine then. Thank you very much indeed. Thanks, Marc.